You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everyone, welcome back to the Advisor's Option, the program here on the Options Insider Radio Network. For all of you out there, the busy financial advisors and asset managers who are looking for ways that you can incorporate options into your portfolios, some education, some tips, some tricks, some buzz from the industry, all that latest fun stuff, as well as, of course, for all of you out there who may indeed be in the market for a new financial advisor or asset manager. Maybe you want to know what sort of skill sets they should bring to the table from an options perspective. Well, we've got you covered on the Advisor's Option program. My name is Mark Longo, coming to you from the Options Insider Radio studios here in the options mecca, the options capital of the world, Chicago, Illinois. And of course, we have quite a few episodes of the Advisor's Option for you guys to sink your teeth into, many, many archived episodes. And where's the best place to check out all those archives, as well as, of course, for all of our other dozen programs on the network? Well, surf on over to the mothership, the flagship, theoptionsinsider.com. That's probably the easiest place to get all of our information there, all of our written content, our breaking news from the options market, education, unusual activity, et cetera, et cetera. And then when you want the radio, you just click on the Insider Radio Network tab, top left corner of the homepage, and you're off to the races. All 13 programs available for you to download or stream till your heart's content. Of course, if you just want direct access to the radio via your usual platforms and iTunes, TuneIn, Stitcher, pretty much all the major online audio outlets, you can find it all there. Just search for Advisor's Option or grab our main network feed. And if all of that's too much work for you, you can't be bothered, just grab our Options Insider Radio mobile app, available on all of the leading app stores, and you can just download and stream all of our shows till your heart's content. And of course, baked into the mobile app is also all of our contact info. If you have a question, a comment, we love to hear from you guys. And of course, we're going to feature a lot of those questions and comments today. And joining me for this extra special office hours edition of the Advisor's Option is a returning guest to the program. He joined us back in Miami at the big options industry conference, and he is returning once again. He is Patrick Stiefel, the director of trading over there at Swan Global Investments. Patrick, welcome back to the Advisors Option Program.
Thanks, Mark. Good morning. How are you today?
I'm doing very well. How are you?
I'm very good.
All right, then without further ado, let's dive right on into the office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everyone, like the man said, this is the portion of the program where you guys get to steer the ship and take the reins, if you will. We get so many questions on this program. We only get to put out an episode once a month that we want to make sure we get to all of your questions. We had such an overwhelming bottleneck of questions. We thought, what better way to devote our time this episode than to answering all of your many and myriad questions about what's going on in the world of options, how do these products work, et cetera, et cetera. We're going to kick things off here with the first question from Peter D. He writes, the topic we touched on in some of our other programs, but I thought it was important to bring it up here as well because it directly impacts and concerns a lot of the people in the advisor and asset management arenas as well. And the question starts off here, stocks are being hit by latency-sensitive strategies like high-frequency trading. Is that happening in options as well? Should I steer clients to other products instead? And like I said, we touched on this before on some of our other programs and the degree that HFT is impacting marketplaces. And from an options perspective, it certainly is nowhere near the extreme degree that we're seeing in the quote-unquote Delta One products like futures and stocks, for the straightforward reason those products are easier to flicker in and out of and do a lot of these strategies like latency arbitrage and fee arbitrage and a lot of the other things that you see done in a lot of these Delta One type products. We are seeing some incursion into the option space from those traders, but options just by their definition, by their complexity, a little bit more difficult for a lot of these firms to wrap their heads around, certainly more expensive to do and also more risky because they're just looking at your average big name like Google or Apple, hundreds, thousands of different strikes, many series, calls and puts. Having to update and flicker into all of those is a daunting prospect from a systems, from a connection standpoint. So that's why we haven't seen a lot of intrusion. But that said, I want to make sure, Patrick, I get your input on this as well, because I imagine you're in a similar boat to a lot of our listeners and potential listeners out there that are looking at maybe entering the option space, and they're concerned about maybe having some of their larger orders impacted by some of these headline-making ARB strategies and latency ARB strategies that we're seeing a lot of in books like Flash Boys, et cetera. So you're the director of trading over there. What's been your viewpoint on these types of strategies? Have they been negatively impacting your ability over there at Swan to put up some of your large blocks of options, or is this really kind of just a small issue for you guys, or maybe a non-issue at this point?
Well, I think you touched on most of the key points in this matter. Remember that the stock price is only one of the 5 components going into the option pricing model. So when the stock gaps, the option prices will adjust accordingly. And the great thing is you can actually use options in these cases. You can get out of the money options just in case you're concerned that a move might be exacerbated by high frequency traders or any other event. So we have not seen latency issues. We have not had problems with getting size done in this matter, but we do need to track it, and we do evaluate whether or not moves are being affected by HTFs and whether or not latency is an issue for us. People are talking microseconds now as opposed to milliseconds, and when you're working with brokers and you're in the biggest, most liquid names, it's really usually not an issue.
And you guys are a bit of a unique use case, too, because you're mostly staying, like you said, in the big listed liquid issues like SPY and others, where you could usually find some counterparty for what you're doing. You guys are also playing a little bit of a different game too. You know, you're rolling out there essentially multi-year puts and things where the HFT ARB strategies aren't really playing that much. But still, it's good to hear that you guys are not really seeing this as an issue. I'm sure that will come as some consolation to the listeners out there who've been seeing all these negative headlines and think, oh, if I get into these options things, I won't be able to get a block of 10,000 done and whatever. You're saying that's clearly not the case.
No, not at all.
Great.
No.
Well,
And we're absolutely aware of it. We're constantly monitoring any sort of outliers.
Well, there you go, Peter D. You can rest easily knowing you can get into options, and you shouldn't really be worried about steering your clients into them if they're worried. Particularly if most of the clients, I'd imagine, would be in the 10 to 100 lot range, and those trades aren't really impacted by this right now at all. All right, moving on to our next question that comes from Batram. I'm not sure how to pronounce all these different handles out there you right say, so if I butchered it, I apologize. Thank you for the information you provide on your advisor's option program. Well, you're welcome, Batram. He goes on to say, I found it very useful in my business. I've evaluated multiple online platforms for use with my clients, but haven't found the optimal solution yet. I would like to hear your recommendations for platforms that can handle basic covered calls, put rights, and collars on approximately 200 separately managed accounts. My concerns are ease of use, reporting, and compliance. Cost is less of an issue as I don't mind paying for good functionality. Patrick, this is kind of a recurring refrain for us here on the program. It's kind of in many ways one of the holy grail questions we hear from a lot of people in the looking to enter the options world from the advisor perspective. You know, I think Randy's even mentioned this on the show many times, kind of how just antiquated a lot of the tools you guys get presented with a lot of these firms are. I mean, your average retail guy coming to a big options platform, options brokerage house with, let's say, $20,000, they get all the bells and whistles on the nice front end platform with the great UI, the great tools, et cetera, et cetera. And I hear time and again, you know, from different people looking to onboard, let's say 20 or 200 million at firm X, and they get what amounts to essentially some glorified spreadsheet through some backdoor program that's nowhere near as robust or functional as what the retail guy is getting. So this is kind of a common concern. I know you guys over there at Swan in the past have had to surmount this by developing your own tools, so that's in and of itself a bit of an indictment on the space and the tools they provide to you guys. So I'm curious if you have any updates on that, if you've seen any improvements in the landscape, in the offerings from the platforms in terms of what they're offering funds like yours and guys like you to onboard with them, or do you still recommend to most of the advisors out there who have the means or the assets to kind of just build their own?
Right. Well, these smaller shops, it's going to be tough to build their own. Even we have limited capacity in building everything we might want to build, and we have over 2.5 billion. So everybody has to truncate their technology budget to some degree. And also, you know, for a plug, Swan can offer sub-advisory services using our tools. But if I had to pick a couple platforms, I think Interactive Brokers provides some risk analytics, some trading tools for option strategies they're almost as good for the institutional investors as they are for their retail clients. I think IB does a good job of that. And I think TD Ameritrade, although it might not be as robust and flexible as Thinkorswim, which is their retail platform, TD Ameritrade does offer some solutions. And there's folks in the back office here at Swan who can set up advisors with a referral at TD if need be.
Well, there you go. You can get your help over there at Swan, and that's a good recommendation actually for the sub-advisors who can use your platform. That's a great way to go because you guys have obviously built platforms that are specifically designed to address this market. So if you're a smaller advisor, maybe contacting Patrick or Randy over there might be the way to go to talk to them or have them walk you through some of their offerings over there as well. But I kind of certainly agree on the major platform side. IB seems to be kind of the consensus choice. They, in many ways, cater a bit to this audience, and they go after the more sophisticated clientele. It's a bit of a downside for your basic retail guy who wants to use them because their platform could be a bit overwhelming, and their customer service in terms of helping on that front is kind of widely regarded as being non-existent. But if you can handle that, that's why I say it's more for the sophisticated clientele that can handle this, and a lot of the advisors out there fall into that category, then that's probably the choice for you. And also, Thinker or the TD Ameritrade platform, they have made some significant strides in trying to go after this audience. It is a bit of a shame. I remember back a few years back when we had a panel at the OIC conference. I think it was in New Orleans. It was a few years ago. We kind of came to the consensus there about the advisor audience and what platform is best for them. One of the ones we came up with that was really the best choice at the time was the Brokers Express platform, which, as we all know in the space, has since been unwound and shut down by Schwab. So that was one of the best choices a few years back, and that's now no longer an option, which is a shame. So hopefully we're seeing, and it sounds like from these developments you're mentioning here, that we're seeing more options, pun intended, for people out there. But this still is a problem, and it's one that hopefully we'll see even more resources devoted towards. And we obviously work with a lot of firms in the space here at the Options Insider. And from what we've seen interacting with them, advisors are a key audience for a lot of them these days, and growing more so every month. So hopefully that'll show in some of the resources being devoted to these platforms going forward. All right. Let's see. Next up, Neal M. He writes, I recently attended a seminar, I'm scared already, Patrick. Let's see where he's going. Where a financial advisor mentioned using straddles and strangles to make money no matter which direction the stock moved. Yeah, I've heard this one before. He goes on to write, hey, he was a little light on specifics, so I did some Google research and found your program. Well, welcome to the show, Neal. He finishes up here. Can you please give overviews of these strategies and explain if they are suitable for longer-term investing via a retirement account? Well, Neal, this is an issue we've encountered before. That's kind of it used to be the old late night infomercial. I guess it's also making the seminar circuit as well. Kind of the make money no matter where the market goes using options, and they tend to usually be referring to straddles, sometimes, as you mentioned, strangles as well. They tend not to get into some of the downsides of those strategies like decay, et cetera. So they tend to kind of wash over that stuff, which is always dangerous. But our friend Neal, and I'm sure a lot of our listeners out here, curious about straddles and strangles as well as their suitability. So why don't you go ahead? I'll give you pride of place on this one. Why don't you walk our listeners through a straddle and then, of course, the related strangle, and then your viewpoint on whether those are really viable options, again, pun intended, for a longer-term retirement account type investing.
Okay. Straddle would be buying or selling a call and a put, the same direction, buying a call, buying a put, usually at the money, but always on the same strike. Strangle is out of the money call, out of the money put, going the same direction, buying both or selling both. And a funny thing, if we get a little bit technical, is you can put a straddle and a strangle together and to put yourself into what's called an iron butterfly, which has both defined risk and defined reward properties. So you can put some of these sort of, if you will call them, high-risk strategies together to put you into a well-defined risk-reward scenario. I personally, when I was a prop trader in previous lives, the CBOE and whatnot, I would really like to buy straddles if I was very certain that the stock was about to move. I know there's news coming. I know that the stock is about to have earnings. Pretty sure it's going to move, and volatility doesn't seem to be priced too high. But as Mark alluded to, if you're just buying options and you're not selling options against them, you not only have time decay risk, but volatility could come in on you, and the price of the options will depreciate, perhaps immediately, but if not, at least quickly.
And then what about your viewpoints? It sounds like I know which way you're headed, but your viewpoints on using them in, like, say, an IRA as a more buy and hold type strategy. Yeah.
I would not recommend trading just strangles or straddles outright in the IRA, especially just blindly selling straddles as a practice. Anybody who's in the business of buying and selling straddles should take some options courses, read some books. If you're going to do it, please start with a one lot. Go through some iterations to see how the P&Ls will behave, because when you sell options, you do have unlimited risk, or selling puts, you have unlimited risk with the stock to zero. And when you buy options in general, your risk is limited to what you pay for them.
I'm glad you mentioned the iron butterfly. It's one of my favorite strategies, as of course involves a long straddle, short strangle, or vice versa. It's a great way if you want to combine, like you said. Like Patrick said, these two positions, there's a good way to do it in a risk mitigated fashion, so you're not just laying out all this money with no idea of what you can make or how much you could lose, et cetera, et cetera. If you want to learn more about those types of strategies, we did cover them on the show. It's been a little while. Maybe we're due for a refresher. It was our Spreads with Wings episode back from August of 2013. So about a couple of years ago now. Maybe we are due for a refresher, Patrick, on some of the more advanced, exotic type multi-leg strategies, but still an interesting one. And as Patrick said, these are by no means suitable for the kind of buy and hold, set it and forget it type of trading a lot of people like to do in the longer term IRA accounts. In fact, as Patrick said when he was on the market maker, we both kind of came up from the same similar backgrounds in the market making space. And one of the tools we had at our disposal back then, again, not to get too technical, was in order to defend these types of long premium, we used to call them type positions, was a tool called gamma scalping. You'd buy the underlying below a level where it's trading right now and try to sell it above, essentially trying to scalp the underlying. And that would help offset a lot of the decay you would experience in these long premium type positions like a long straddle or indeed a long strangle. That's a more difficult prospect, certainly for a lot of retail out there, and even for a lot of the asset managers out there who don't have time to babysit these things on a degree you need to really make sure they remain profitable. And also you need a lot of margin in the account, and it ties up a lot of capital. So one of the primary strategies you would need to use to offset the decay you're going to be paying on a regular basis is not really viable for a lot of the end listeners out there. So that's another reason why these strategies are not suitable. And of course, as you mentioned, the time decay. You're buying two options on the same strike, so twice the decay, all the other fun that's going with it. So you can imagine taking that and putting it in an account for 6 months is probably not the best way to go. Even though it may sound on the surface, this is a fantastic approach. It can make money no matter what happens. There are a lot of downsides, pun intended, with this type of strategy. So bear that in mind. But good question. Glad to see you're catching out the show through Google. We love to see all you new guys coming in. All right, next up, we have a question from AVX16. He or she writes, the Fed is set to raise interest rates in December. While this raise will be nominal, it sets the stage for future raises in 2016. I'm a relatively new convert to options thanks to this program. Well, welcome. It was, AVX16, welcome to the world of options and indeed to the program. He goes on to write, I've only used them in the current zero rate environment. Are there any performance peculiarities that I should know before putting my clients into options positions in a rising, I think he means a rising rate environment here, bit of a typo. My primary strategy is 2% out of the money covered calls on SPY, although I'm considering more aggressive income strategies such as covered strangles and iron condors. With the prospect of a rising interest rate environment on the horizon, are there certain impacts on options that I should note before using these strategies for my clients? Well, great question. A timely one. Patrick, we started seeing a lot of these come in over the last few months, as you might imagine, as the prospect of the Fed raising rates finally seems to be not a certainty, but closer than it ever has been in the December cycle here. So seems like rates are going up. We've had questions coming in. We haven't had these questions in years, and all of a sudden people are asking us about Roe and all these other things again. So seems like rates are on a lot of people's minds out there for obvious reasons. So why don't you go ahead and walk them through the essential basic relationships between interest rates and, let's say in his scenario, an interest rate raise and the impact it would have on your calls and puts out there and a lot of your listed issues.
Sure. So first off, and we're not going to make any predictions on what the Fed might do, but if we can just note the recent history, the Fed has continued to lean dovishly and has continued to shock the market with dovish surprises and raise later rather than sooner. If you remember, at one point when unemployment was going to hit 6.5%, they were going to raise rates. Well, unemployment's at 5%. If you remember, at another point they said end of 2014, early 2015 will definitely be the first rate hike. Well, we haven't had it. So just one caveat there to note recent history. You're selling covered calls 2% out of the money, especially if you're selling short term. This is unlikely to be greatly affected by interest rate hikes in the near future. Also, rest assured, as interest rate moves tend to affect the long-dated options more than the short-dated options, rest assured that the options pricing, the market pricing the interest rate, is using forward rates, treasuries, notes going out 2 years if the option's a 2-year option, and it is forecasting 2.5% rates out 10 years, but even 2 years out, we're looking at rates closer to 1% and not the 0 to 25 in the overnight rate. So it's already priced in. If there's a shock that they raise too fast or don't raise fast enough, then the bond markets will trigger the interest rate component that goes into the pricing model in the back month. So there's no need to get overly concerned on how short-term interest rate moves might affect your options position, especially short-term options.
I'm with you there on the Fed probability of raising. I've been in the no raise camp for a long time, and it seems like they continue getting up until the point of where they think they want to raise, and then they pull back from the abyss again and again. Seems like they may, who knows, maybe they might be doing that dance again, but it has sparked a lot of interest, a lot of questions from our listeners regarding, Rho, that oft forgotten Greek, as well as, of course, just the impact on rates. So it's worth covering that again. Maybe we'll get into it on I'm sure we'll have more questions on this. And when the rate raise happens, and as Patrick said, it's already priced in, and particularly for this strategy, where you're really going to encounter it is, like you said, in the meatier, longer-term type products that have a bit of a good cost of carry to them involved in the option. That's where you're going to see some rate impact. That's the kind of stuff that Patrick's trading out there a lot. A lot of these 2-year puts on SPY and things like that. That's where you're going to see that sort of interest rate impact, not in front month, essentially at the money or slightly out of the money calls and SPY. That's not really where that game is being played. And so that's for the lion's share of you who are out there doing strategies like this in SPY or Apple or Facebook or what have you. This is not really going to be a concern, and really won't be a concern unless you really fundamentally change your strategies. Good question, though. I'm sure we haven't seen the last of the rates, the rates question. Next up, Patrick, you have a question here. He's getting into the dark and dirty world of options. He wants to know about naked options positions.
Yeah.
So children, cover your ears out there. This one comes from Angelo M4. He or she writes, "Hey, can you clarify what is meant by a naked options position versus a covered options position? Sexy name aside, is the former truly exposed to unlimited risk?" Angelo, people seem to have naked options on the mind a lot. People have written in a lot lately with questions like this. I don't know sure what it is. Maybe a newsletter covered it somewhere. I don't know where they're coming from on this, but it's a good question, worth considering here. And obviously, naming convention aside, maybe we should walk our listeners here through just the basic difference, between what a naked options position is versus a typical covered position, and then is he right about, are you then exposed to essentially unlimited risk?
Sure. Yeah, well, the term naked doesn't always mean more risk. I do agree that it means it's not covered. And so if we can go that route, if you're selling a call against a stock holding, you're writing calls. You're not naked calls. If you sell the call and you don't own the stock, you are naked selling a call. You can also buy a call naked, which, as we said before, buying a call naked for $2 in an equity, your maximum loss is $200, even though you're naked long. So naked essentially means unspread or not covered. For example, you can be long a call spread for $10, or you can be long a call for $1. Now, your long call for $1, you have $1 of risk. Your call spread that you're long for $10, you're not naked, but you could lose the entire $10 in some cases. So naked doesn't always mean more risk. It just means not spread off in our interpretation.
That's funny. We were just talking about this on another program recently on the network. And it kind of occurred to us there that you don't really hear naked appended to long positions that often, to long premium, to long options positions. It just seems like in the common vernacular, in the common investing public out there, naked equates to short and also equates to a lot of risk. That seems to be the use case. It's used in the lion's share, 99% of the cases. I agree. I think of naked being essentially the same way you described it, unhedged, unspread, no underlying against it kind of thing. So long and short to me are both naked, but it seems like the lion's share of the public, and indeed a lot of the asset managers out there, think of naked on the short end of the spectrum. And of course, naked essentially just having no underlying leg. So if you think of it from a short perspective, of course, listeners, then the short put has finite risk because the underlying can only go to zero. But the naked short call, of course, does have the proverbial unlimited risk because the stock can go to a million or whatever. There's no upside limit on it. So that's where your real, quote unquote, unlimited risk comes into play. On the long premium side, buying options, your risk is essentially limited to what you pay for the option. So you're essentially looking at more at the slow death above 1,000 cuts of premium decay, time decay, which is, a lot of people don't think of that really as being risk. For some reason that doesn't, even though it clearly is, as we talked about earlier with straddles, people don't think of that in the same terms as having a stock go to 1,000 and losing all that money on a naked call. So they don't think of them in those terms, even though they are very much still risky positions. But you can only lose what you put into it. Again, a nice thing about using options, and on the long side at least, is that your outlay is limited and your risk is limited as a result. But still, people have naked on the brand. I'm not sure what it is. Maybe it's this time of year, Patrick. I'm not sure where these come from, but it is kind of
Friday.
Maybe. Yeah, it's the Friday crowd. All right, next up from Beansy. I like that. He or she writes, hey, is there such a thing as a commitment of traders report for options? Something that shows bullish and bearish positions in the marketplace. Of course, he's referring, Patrick and listeners out there, to what we see out of the CFTC typically, where they put out their commitment of traders reports in a variety of different products, crude oil, et cetera. All the products that come under the CFTC domain, which is typically the futures and futures options products, they will put out reports for that. So in that sense, you can get a breakdown for options in a lot of those products. And when the CFTC puts out their crude oil commitment, for example, they're going to break down the long futures and the long options, and vice versa for some of the other products out there that they cover. So in that sense, there are commitment of traders reports for options. But I have a feeling Mr. or Mrs. Beansy is more referring to, let's say, the Apples out there and the SPYs and some of the more equity and index options that most of our listeners on this program like to trade. And in that sense, you're a little more out of luck on the more SEC type of front. They don't really put out those types of reports. But on the plus side, you do have more choices at your disposal from a tools perspective to try to find this data for yourself. There's many more platforms and analytic suites for equity and index options than there are for futures and futures options. It's just a fact. So you can use a lot of different platforms. Ones we like to use at the Options Insider for performing our analysis, doing our programs, things like that, are certainly Trade Alert is a great one because they provide all this data. You can pretty much pull up you can see exactly what's open here. Looking at things like open interest is obviously the big thing you're looking at when you're looking at this type of position and changes in open interest. And Trade Alert will certainly provide that. We also use LiveVol Pro. It's a great one. It's more of an analytics suite, but they will have the open interest in there, and you could scan for it. And there's a lot of other databases out there that will allow you to scan and analyze names by volume and open interest. And that's kind of what you're looking for. So it's more of a kind of build it your own type thing. But the plus side is that you could do this yourself with some readily available off-the-shelf technology. It's not really too hard of a thing. You have to pay some money for it. None of those ones I mentioned are free. And a lot of the good brokers out there may provide some of this data as well. So it's worth checking with your broker because that's free. And that's a good starting point. That said, do you have any recommendations or tools or platforms? And how do you guys go about kind of replicating this information for yourselves over there at Swan, Patrick?
Okay, sure. So you want to look at the put-call ratio with any name. You can probably find that on the web. The indexes obviously have a lot of information there. It just gives you an idea of how many puts you're trading versus how many calls and whatnot. And then if you can find it, you want to find some skew numbers. And skew numbers will tell you, are people buying puts relative to calls? The CBOE skew index shows us that the SPX usually trades at a skew for anywhere from 115 to 130, which means puts trade higher than calls. So think about skew. And then the most important thing that I think might apply to this question is supply and demand. And in the case of options, we can use volatility, the relative volatility of the options, maybe compared to historical volatility and stock ranges lately, or maybe compared to where is the volatility relative to the last time the stock traded this price. If it's high, then there's probably more demand from options, and we can assume that people are buying options. And if it's low, then there is supply. And people are flooding the market with option sell orders. Maybe they're selling straddles, like the viewer before had mentioned. Don't start with a bunch of straddles in an IRA, as Mark said. Anyway, the volatility can be an indicator of supply and demand.
I like it. Getting into skew, blowing people's minds. That's good stuff.
Yeah, right.
I like it. We have covered that several times on this program as well. If you want more information, what the heck's he talking about there? Volatility skew. I don't have the episode numbers at hand, unfortunately. But if you go to our archives there on the Options Insider or in iTunes, wherever, to search for volatility, we have broken it down multiple times. Things like the VIX and volatility skew, so you can dive more deeply, sink your teeth into that if you like. And I heard you mentioned the put-call ratio over there, Patrick. I'm curious. This seems to be kind of a bit of a dogmatic schism in the options world. Some people really are big fans of that. Some people not so much. Where do you fall on the utility of put call? Do you use that a lot? Or you think it's kind of an overplayed sentiment indicator?
Mm-hmm. It's going to be one of those things where we track it. We know what it is. It's very unlikely we are going to have it in our rules triggering a trade for a client block. Very unlikely.
Yeah, I kind of fall into that same boat. It gets quoted a lot, and people tend to follow it. It's one of the low-hanging fruit of the options indicators out there, but I've never really found it that particularly useful unless it's extremely aberrant or something else like that, where maybe then it's worthy of some note. But I tend not to put as much faith in it as maybe a lot of other people out there tend to do, just because it's so widely covered and reported. But an interesting one nonetheless. And again, a lot of ways you can kind of roll your own in this sense when it comes to your own commitment of traders report. But unfortunately, there's no easy one you can go grab from, let's say, your regulator and look into it. Even though if you can make your own, you can make it a lot more sophisticated, like Patrick was just saying, things like volatility skew and all these other things that no regulator is ever going to give you. So on the plus side, you can do that and make it a little bit more useful and functional for you and for your clients. All right, great questions. We're just rolling through a bunch here, Patrick. We'll see how many more we can squeeze in on the episode. Let's see. We got next up, we have a question from Ben. Ben A. He writes, hey, are the options prices more volatile going into events like earnings and crop reports? What is the cause of volatility in the options market? Where does it come from? Well, he wants everything in the kitchen sink with this question. Again, for detailed dive into volatility, check out our archives to search for the episodes with volatility in the title. There's been a few of them. So we go very, very deep into that. Clearly, we won't have time to go as deep into it on this episode. But maybe, Patrick, if you want to give a bit of a primer here to our friend Ben on some of the root causes of volatility in the options market. Where does it come from? And then he wants to know kind of the $10,000 question here. Are options prices going to be more volatile, aka more expensive, going into events like earnings and crop reports?
No, sure. It's an important question. And absolutely, option prices should be elevated going into known news events that should move the underlying. We've talked about the underlying. We know the underlying movements have to affect the option prices. And there's two ways to play it. If you think that an earnings report in a given stock is overblown, the media has overhyped it, maybe the stock isn't going to move a lot, then you might have an opportunity to sell some option premium, whether it's an outright strangle straddle or whether it's a spread. And if you're right, you will collect a lot in the short-term vol crush. And that short-term vol crush will likely come from an answer to the previous question, option sellers coming in saying, we don't think the underline is going to move, or the underline hasn't moved enough for us to scalp our gamma, like Mark alluded to earlier in the show. So they will push your position your way, sell options, and you can get in there after the vol crush and scoop up the options that you sold before the report. Same thing. If you're sure that there's a move coming, for whatever reason, it doesn't have to be an earnings release. You can get long options, and because of all the rights associated with options, you're basically long risk. And if there's fear in the market, up or down in the stock, or the stock moves, volatility will go up. You will profit, and you'll be one of those few owners of options that get to put your offers out there and sell at juicy prices.
Everyone wants that juice at the end of the day when it goes into earnings. And yeah, that's of course the moments when the market is expecting big moves in the underlying, so you can expect a little bit more juice, a little bit more volatility in those events. I've often used the analogy of essentially like a balloon. Volatility is filling up the balloon like air going into the event, and it's getting more full and more full and more full. And then once the event happens, the expected event unfolds. unless there's some dramatic surprise that merely causes the underlying to move dramatically, that balloon tends to pop and all that volatility goes rushing out, and you see that played out in essentially the premium, the extrinsic value, if you will, of all the options going after that earnings event. So it's a known event, but riding through that balloon popping phase, the announcement can be a bit of a turbulent process. So we don't often recommend, particularly newcomers, really taking that route because it's a difficult road. In many ways, you're just rolling the dice at that point. So interesting question and very important one. Certainly we are at the tail end of earnings season right now, but as we all know, another season is right around the corner. So this question, always relevant, always topical to us here on the program. All right, next up, we've got an international question. At least he wants to know about international markets here, Patrick. This comes from Sebastian. He writes, what is the status of the Chinese options market? Are options going to be listed anytime soon? Do you expect they'll be accessible to outside investors? I have multiple clients interested in investing in China, but I don't see many viable options offerings. Thanks, Sebastian. Well, I'll take point on this one, Mr. Patrick. This is something we've watched quite a bit here with great interest over here at the Options Insider and Options Insider Radio Network. As you might imagine, we're always interested in new options markets, and we've seen a lot of anecdotal evidence coming out of that part of the world that there is a strong demand for options content and education and information. We get quite a bit of traffic from mainland China, even though we do nothing to facilitate it whatsoever. We don't translate our content. We don't really make it easily available, and yet they still come to it. So if we actually put content out for them, it would be, I think, an interesting thing. And so we explored that very aggressively about a year and a half ago, maybe almost 2 years ago now, when there were first rumors of China really aggressively launching listed options. They ended up punting at that point. It didn't happen. And they ended up moving it forward to when they finally listed options. I believe it's on the Shanghai 50. I'll have to see there's an index they listed options on back in February. And that is really their first foray they've made into listed options of the type you and I would be familiar with. And it was a very tentative list. They haven't really done a ton of volume. And partly because the government over there hasn't been in a rush to really embrace options. From everything we've heard and people who've been interacting with them over there, they have several concerns. One of them is that particularly the retail public in China, there's a strong gambling culture there, and they're concerned that they will use options as a gambling speculative tool, which is not unreasonable. And so we've actually heard a lot of interesting, maybe almost draconian measures that they were thinking to try to clamp down on that by launching these products with ridiculous multipliers, let's say 1,000 or 10,000, so that no retail person could really afford to trade them, and some other really strict measures. They didn't really go through with that, thankfully, but they've also been reluctant to really fully embrace options. And also, quite frankly, the options market is very much a Western-dominated marketplace, so they've been slow to embrace that because they want to have more of a homegrown marketplace in that sense, and the infrastructure still really isn't there. There aren't any real substantial Chinese market makers yet from an options perspective and things like that. So they don't want to launch these products and have Western firms come in and really dominate the marketplace. There's a bit of push and pull there as well, some nationalistic sentiment underway. And that's kind of why we haven't really seen a full embrace of these. I know I can speak from talking to a lot of firms who are really, really eager to start trading options over there, that there's a lot of demand from firms here and in Europe and other places to try to get in there and start trading more options, and the government's putting the brakes on it. They really don't want to open the floodgates just yet. They have this first test case, and they're going to see how that works before they really expand it. So hopefully they will expand down the road, but unless you're looking at options essentially on that index, that's kind of really your only real game in town from a true listed, somewhat deep, somewhat liquid options perspective. I don't know, Patrick, have you guys been keeping an eye on the Chinese market over there, and what are your thoughts for our friend here, Mr. Sebastian?
Yeah, we're not going to trade the China 50 anytime soon for all the reasons you alluded to. Listeners could think about the Kospi, the South Korean index, a lot of good options liquidity there, and the Hang Seng in Hong Kong has listed options. They might not be as deep as you might think. And then EEM, the Emerging Market Index, Swan has some products available, hedged equity EEM. The index is roughly 20% China, and the EEM has multiple underlines with super deep, pretty tight spreads in options, going out all the way out to leaps, of course.
And that's a good point, because I was kind of referring mostly to the, directly listed in China options. But if you want things that just have Chinese exposure, there are other indices with options on them and other products that trade in the Asian hemisphere there that are liquid, like you mentioned, Kospi and others. Again, some of that liquidity may be illusory a little bit, so buyer beware. But that said, Hong Kong has a viable, Singapore, they have viable marketplaces. You can try to approximate some of that Chinese exposure through them if you're so inclined. But yeah, listed directly in the mainland stuff, your options, pun intended, are still quite few, unfortunately. But hopefully that should change sometime soon. All right, next up, cranking along here, Patrick. Got time for a few more. This question comes from Inc 451. He or she writes, "Hey, I saw a recent headline stating that the second BATS options exchange launched on November 3rd, bringing the total number of options exchanges to 13. Should I be excited or concerned that there are so many exchanges listing SPY and Apple options? In my experience with equities, more venues does not always equal more liquidity and deeper markets. In fact, it can frequently be the opposite." Well, Patrick, he is indeed correct. We did launch the Baker's Dozen exchange, number 13, earlier this month. Again, he's joking here, but he's kind of really half right. Most of these exchanges, with the exception of the SIBO, are really pretty much listing the same products, the Apples, the SPYs, the Facebooks, etc. So they're not really doing a whole lot to distinguish themselves. What's your take on essentially the what he's referring to here, the growing fragmentation in the options market, and has that impacted you guys? I mean, you guys are out there putting up large blocks and having to get some significant size done in some of these products. Have you seen an impact of that fragmentation on your trading, or has it really not been an issue for you guys?
Sure. Well, anywhere where we see an impact, we have all kinds of tools, multiple brokers we have relationships with where we can work around those challenges. We haven't met a challenge of that type that we haven't foreseen or encountered a few months in advance. For advisors, if they can find a platform that will give them direct exchange routing so they can choose BATS2, they can choose CBOE, they can choose Amex or Philly, then they might have an advantage as opposed to using the platform's algorithm that might send it to an exchange that gives them an extra tenth of a cent payment for order flow or something like that, which is one of those ugly words that we'd love to get rid of.
Yeah, I agree with you there on the payment for order flow. I can certainly see that go, and that comes from my old market maker days where I just saw the terrible negative impact of those types of taxes on the business, and and certainly we've seen it profiled in much more depth in tomes like Flash Boys recently, and getting a lot of heat as a result of that. But it is interesting. I'm happy to hear you guys aren't really being impacted by this, because in many ways you think you guys might be, because particularly for some of the less liquid stuff you guys are trading, like the farther off puts in SPY a couple of years out, not as many players out there. So if a fragmentation may hit you, it may be in some of those types of markets. But it sounds like you guys have found good ways and tools to work around that. And in general, if the Swan guys can do it with their far off puts, you guys should be able to navigate it. The one area I will mention that I have heard a lot of people really coming back to us, even on the active retail side, 10 to 100 lot guys are starting to see some impact of this, is on the multi-leg spreads. Because just part of that is just the nature of the way spreads are executed in the options market. You will see usually quoted to you what's the NBBO for the spread, the National Best Bidder Offer, and it usually combines a bid from one exchange and an offer from another one. Problem is, spreads don't trade that way in the options market. If you put a spread order in, unless you're working with a very sophisticated broker, and you guys might be who could leg it between the exchanges, your orders typically for most of the active retail guys, even for a lot of the advisors out there, is going to be routed to a spread book on a certain exchange, and that the reasons it may be routed there could have nothing to do with the MBBO. It could have relationships with your broker, et cetera, et cetera. So now you have an MBBO showing maybe a bid and offer on two different exchanges, and your spread's actually on a third exchange, and it's not going to step up and meet those orders, those offers and bids on the other exchanges, and so your order ends up hanging there and not filled, and it's a very frustrating thing for a lot of people. We hear a lot of negative feedback for this. A lot of brokers have invested a lot of time and money to try to fix this, essentially trying to make these spread books talk to each other, because they don't do it in real life. They have to kind of approximate that functionality themselves, or even leg the orders on behalf of the clients themselves, which is a risky proposition. That's where we've seen some of the liquidity issues really starting to play themselves out. Have you seen similar issues out there, Patrick, when you're trying to do, some sort of multi-leg spread orders, or is it you guys are doing more size and you have a little bit more high touch on the execution side? Has that not really been a problem for you there either?
Well, I'll give you one example. of one of the problems that's going on. Last summer, some of the listeners might recall if they traded a lot of SPY options. And of course, SPY is listed on all 12 or 13 exchanges, and it's a proxy for the CBOE's proprietary SPX product. So you can imagine there's a lot of politics involved back and forth between CBOE and the other smaller exchanges. Well, last summer, the spiders for the first time broke through $200, okay, more all-time highs, of course. And they were only listing strikes above 200 every $5 increment, as was per their rule or an OCC rule or whoever decided, some committee. Well, maybe we wanted to buy or sell the 203 or 204 call as part of a spread. Maybe an advisor owned spiders at 190 and wanted to sell calls at the 201, 202 area. Strike didn't exist. We talked to the CBOE. Of course, they're in no hurry to list a security that might compete with their proprietary product. Tried to talk to as many of the other exchanges, and it wasn't until there was enough advisor, retail client, institutional frustration with the fact that there's not a 40 delta call listed. There's a 45 delta call and a 34 delta call, the 200 and the 205. But the ones in between, not listed. They had to change the rule, make an exception, and say, stocks over $200, as long as it's an index-like product, maybe we can go ahead and list an option security on every line, 201, 202, 206, 07, and so forth. So if you want to sell the 204 call, maybe you couldn't do it. Maybe you couldn't sell 4 of those. Maybe you had to sell 5 of the 205 calls to get the same sort of delta exposure, but of course you short more units, so more risk in that way. So it's a frustrating scenario that I believe has to do with the politics of all the exchanges and less to do with what's best for the clients and the institutions as well.
It's a great example. And yeah, the internecine politics of the different exchanges and the way they compete against each other. We could do a whole episode just on that, and I'm sure it'd be very frustrating for our listeners. But that's a good, very specific example of how that could sometimes play out, and the battle amongst these different 13 venues can sometimes play out. Well, we're coming up against it, Patrick. What do you think? You got one more in you?
Of course.
All right. We'll wrap up here with a question from Kevin D. He actually sent it into one of our other programs a while back, but I thought it'd be worth discussing on this program as well, because I'd imagine a lot of the audience for this program would have similar questions. He writes, "Hey, Mark, I love your shows." Well, thank you. Question: what happens to my options if the underlying gets halted permanently? Would I ever be able to close them? I'm remembering Sino Forest from a few years ago in Canada. The stock got halted pending a fraud investigation and never came back. I'm worried that I won't be able to cash in on my BABA puts. Thanks, Kevin. This is a good question. I'd imagine some of our listeners out here, Patrick, have similar concerns about putting on an options position, and then the underlying essentially just gets halted, and in the case he's mentioning permanently. Have you ever had this? Oh, let's start off this. I want you to walk our listeners through this scenario where the underlying gets halted. What happens to the options, A? And then B, has this ever occurred to you in your trading, and what's been the impact of it?
First of all, the exchanges should, and in some cases are mandated to stop options quoting and trading capabilities when the underlying stops. They're all in line. There are federal regulations in many cases, but just in the sense of ethics, they really try to halt immediately. Second of all, and I can't speak for the OCC, but the Options Clearing Corp is in existence for the sole reason of making sure that there's a principal and agent and a buyer and seller on each side of an options transaction, and to see to it that all the major clearing firms make sure that all the components that go into the options, the right to buy or from a buy or the obligation from short options, that the whole process is seen through. And I have had experiences in equity names where the stocks halt, and you can exercise your options. You can inform your clearing firm that you would like to exercise your options, American-style options in equities, even if the stock's halted for a number of days. So, again, check out the OCC website. Don't necessarily take my word for it on what's guaranteed. But there are, not every federal regulation or organization is set up just to add red tape. There are some good guidelines and protections for consumers out there, and options are highly regulated.
OCC, of course, are partners on this program. They are indeed the parent company, the the owner, if you will, of the Options Industry Council, for which Eric and Alan, who've been on the show many times, are part of. And they're indeed, as Patrick alluded, they are pretty much your good one-stop shop for information on this kind of stuff. What he's kind of referring to there is kind of that weird nebulous, realm where we've seen, of course, everyone has seen short trading halts intraday. Something happens, the name gets halted for a little while. That's not really the end of the world. It can certainly be disconcerting if you're trying to trade options on it, but it's not going to stop you from trading them forever. What he's kind of referring to is more in that limbo, that weird where your name's halted, and then you think it's going to be a short-term thing, and maybe it stays halted, remains halted, and you're saying to yourself, what for several sessions, and what's going on? That's where you definitely want to look to OCC to see if they have some sort of determination of, hey, this name has been halted indefinitely. Here's what we're going to do on this name. Here's what happens to your options. And like you said, like Patrick mentioned, you also have your own options there. If you determine that whatever is happening in the space is something you don't like, you want to get out of them, you can't exercise those contracts. You'll lose, of course, the time value portion of those contracts, but that may be a small price to pay if something really terrible or crazy is happening in the underlying and you want to just get the positions that you essentially paid for with the option. So good question, Kevin. I'm sure this is an interesting one. I don't know about you, Patrick, but I can go for a lot more, but unfortunately, that's all the time we have for this special office hours extended edition here on the Advisors Option Program. We love to hear from you guys. We didn't even get to all the questions you have. We have a lot more in the hopper. We love to hear from you guys. Keep sending them in. Even if we don't get a chance to answer it on the show, we, of course, read them, and we'll try to answer them to you guys whenever possible. If you have specific ones for the Swan guys, we'll make sure to forward them to them so they can answer them for us. Makes our life a lot easier. So keep them coming in. Twitter.com/options, Facebook.com/the Options Insider. Stock twits, we're Options Insider, or of course on the old website, you can hit us up, post a comment, or use our feedback form. A lot of you like to do that, or just the old-fashioned way, questions at theoptionsinsider.com. All of that will route to us, and we'll route it to the appropriate show. And of course, it's all baked in to our mobile app. Like I said, that's going to do it for this episode of The Advisor's Option. But before we go, Patrick, anything you want to leave our listeners with, anything that's coming down the pike over there in the land of Swan Global Investments you want to let them know about, maybe a little bit of a tease until the next time we can do the old Advisor's Option program?
Sure, a couple things. First, a couple of the questions touched on this, and especially the last one. And if you're trading spreads, you likely have some limited risk in these scenarios where these stocks gap. And if you're concerned about stock gaps, it's not a terrible idea to just buy some low-priced options. We call those lottery tickets, okay? Swan doesn't go buying out a lot of lottery tickets, but for a retail investor, I could see where you might want to do that from time to time. Regarding Swan, we actually do have two new products coming out right near the end of the year. We have two mutual funds that are rolling out, foreign developed hedged equity fund and small cap based hedged equity fund, where in both cases we are applying our standard defined risk strategy investment process. Go to our website, learn about the DRS, find out what that means, why we're able to do it on multiple underlines, multiple products, especially the big indexes. And so we're very excited to have our third and fourth mutual funds rolling out. Couldn't be more ecstatic.
Well, that's great news, and I'm sure for a lot of our listeners who maybe want a little bit more ease of entry to your type of approach, that defined risk strategy, maybe they don't want to have to replicate it themselves if they don't have the time to do it. I think the mutual fund is a great option. Again, pun intended. If you'd like to learn more about what Patrick's talking about, then surf on over to swanglobalinvestments.com. You can check out the defined risk strategy, all the different funds. They also have some great content over there. We don't get a chance to discuss it as often as we'd like on the show. The different newsletters, they of course have the blog over there and all the other content they do breaking down their strategies and their performance in different scenarios. So if you're interested in that, listeners, surf on over to swanglobalinvestments.com. You can see it up there on the top corner of the page, their blog, resources, a lot of different things. You could surf around there for a while and really and spend some quality time looking at all the content they have up there. And on behalf of Patrick and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course, for sending in so many great questions. Keep them coming. We love to hear from you guys, and we'll see you next time on The Advisor's Option.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.